Today's video is on the three main types of investments you need to understand, and that's stocks, bonds, and cash. Even if you're planning to invest in ETFs or mutual funds, if you don't understand these underlying investments before diving in, you might end up invested in something that's either too risky or that won't grow enough to actually meet your goals. So take 5 minutes to watch this video and I'll explain them from highest to lowest risk. Let's start with stocks. When you buy a stock, you're buying a small piece or a small share of a public company. This is why stocks are also called shares, and you essentially become a part owner of the company, also known as a shareholder. If the company's stock price goes up, then so does the value of your share, and eventually you can sell it for more than what you paid. That's the main way to grow your money using stocks. However, this is a long-term strategy because within the short term, so thinking back to the past year or even couple of years, company stock prices can fluctuate quite a bit and thus the value of your share can fluctuate. And this is based on the performance and outlook of the company, which can also be impacted by macroeconomics, politics, world events such as pandemics. And so this is why investors buy stocks of companies that they believe will be around for 10, even 20 plus years, and whose value will go up over that long term despite any short-term fluctuations. Stocks are a great way to grow your wealth and get a higher return on your investment for the long run. You can participate in the company's success without having to do anything basically. However, this does come with higher risk in the sense that you could lose a lot if the stock price drops, or worst case scenario, you could lose your entire investment if the company goes bankrupt entirely. That's why one of the most fundamental concepts in investing is don't put all your eggs in one basket. Basically, don't put your entire life savings in the stock of one company. The idea here would be to invest in many different companies, different sizes, in different industries, across different geographies even, and that way it would better spread out the odds of your money growing overall. Now let's move on to bonds. When you buy a bond, you're actually lending money to an institution, such as a bank, corporation, or government. They promise to pay back your original principal amount with interest. So the way you make money is through receiving those fixed interest payments each year, which is why bonds are also called fixed income investments. It's fixed, meaning the interest that you receive does not change over the life of the bond. For this reason, and because you usually receive your original investment back, bonds are considered to be less risky than stocks, but also offer lower returns. Let's say you have $1,000 to invest. Instead of buying the stock of the company TELUS, you decide to buy a TELUS bond and loan money to them instead. If it were a $1,000 bond with a maturity date of 5 years and a fixed rate of 3%, this means TELUS promises to pay you 3% each year and then your original investment back in the 5 years. In the bigger picture, bonds are useful if you want to diversify and lower the overall risk of your investment portfolio. So for example, instead of investing in all stocks, if you were to invest a portion of your money in bonds, this will result in lower risk and less potential fluctuation of your money. Finally, the last main investment type is cash. You may be thinking of the cash in your wallet, but in the context of investing, this refers to a type of cash investments which are safe and liquid. Liquid meaning they can be easily converted to actual cash. Examples are GICs or money market funds. When you buy these, you are, again, lending your money in the form of very short-term loans to credible and established institutions, usually banks or governments, that have a high guarantee of paying you back, which is what makes these cash investments safe and liquid. However, they also offer the lowest returns. This is appropriate if you're saving money to be used within the next 3 years. Say you plan to buy a car in the next year, or you have some big upcoming trips planned that you're saving up for. You could park your money in these cash investments or simply keep it in a high interest savings bank account. Because in investing, less than 3 years is considered too short term to invest in anything like stocks or bonds that could fluctuate, because you don't really want to lose that money that you already know you're going to need. So here, accessibility and safety become the priority over growth. Now you know about the three main types of investments, and you can use this to better understand any ETFs or mutual funds that you're invested in, because these funds are simply a type of investment product that wraps up a bundle of different stocks and or bonds and or cash, for example, a bundle of 30 different stocks. And that's what your money is actually invested in through that fund. So when you invest in a US large cap equity fund or ETF, what that means is your money is actually invested in stocks of large US companies. In investing, higher risk means higher potential reward, such as with stocks, and that's generally used for a longer time frame or longer goals. If you need to use the money any sooner and have less time to grow it, then having a portion of your money invested in bonds can lower your overall risk to match that goal. Thank you so much for watching, and we hope you enjoyed this video and found it helpful. Our goal on this channel is to make investing simpler and more enjoyable, so make sure to subscribe if you'd like to see more.